So, are investors coming back to quality with their tail between their legs after chasing specky companies the past couple of years? Well, that's one, point of conversation I'll be having with Simon Conn from Investors Mutual, who joins us now. Simon, nice to see you again.
Thanks for having me on the show today.
I'd like to just start with that pretty good performance we've seen coming through in some of the small cap names as of late. What do you put that down to?
In terms of the rally into this
morning? That we've seen.
Well, we're seeing people starting to gravitate more to quality and value stocks in terms of true fundamentals. So we've seen, with inflation being higher here and in North America and globally, interest rates obviously are correcting and we're going back to more normal levels. And what we've seen over the last 5 to 10 years is really investors have been chasing very much the thematic, whether it's been technology, more recently in the mining sector. But what we're seeing is people are gravitating more to quality, to industrial companies that make money. Companies that have been trading cheap for quite a few years, they're actually got good fundamentals, paying dividends, and been growing their earnings.
But sometimes you sort of think of blue chips in that regard as well. So why is that happening in the smaller end of the market? Because we're told again and again that if you start to see a slowing economy, interest rates rise, that it could impact smaller companies more.
Yeah, I think artificial interest rates have been so low, it's created this artificial bubble where people have been going, I'm not getting anything for my money in the bank. So I'm going to, it's devalue to cash really, and people have been living in this world of very short-termism, whether it's driven by social media or ETFs. People have been investing, thinking I'm going to make a quick capital gain, and we've seen a huge capital loss in the market over the last 12 months. It's just been down and down and down. Obviously, tech sector today is having a bit of a bounce, but I think it's really woken investors up to thinking about the share market in a different way, back to the fundamentals, looking at good quality businesses that have got earnings that are growing, they're able to grow their earnings and pay dividends. And so what we're seeing in the large caps in stocks like Amcor and Brambles, Brambles getting a takeover bid, an approach which is now being, they've changed their mind on that. But we're seeing that people gravitating to those sort of stocks. And we think there's a whole bunch of stocks in the small cap universe that have good quality businesses whose earnings that can grow going forward that actually look quite cheap.
What's one of them?
Well, look, one we've been buying recently is GUD. That's a business that's transformed themselves over the last 4 years from a conglomerate of disparate businesses. They used to own Sunbeam years ago, a business called Dexium. And they now have a concentrated portfolio of automotive and afterparts brands. So most recently they raised money just before Christmas to buy a portfolio, a company called Auto Pacific Group, which owns the Heyman Reese brand, which has a 95% market share in the towing market. So really strong market position. And investors will know from ARB that this is a sector of the market in the aftermarket supply that you can make really good money. And the company has built a portfolio of brands, Vision X in the lighting sector, which actually can grow organically, which is something that the company struggled with many years ago. So there's synergies to be extracted from all these acquisitions they've made. They've got some really good management team. We think that organically the portfolio can grow, and there's cost outs that can deliver earnings growth. Should earn $1 a share next year, so at $11.80 is trading less than 12 times and yields 5%.
And how about debt levels?
In GUD?
Yeah.
Look at the debts, they took on quite a bit of debt, a reasonable amount of debt, but it's not insurmountable, and the business should generate very good cash flow, given the gross margins are quite high.
Okay, I had a chat yesterday with an expert guest who was saying that you should be looking into the sort of food thematic at this stage of the game. I'm just pointing to food inflation, companies being able to benefit from that. Still demand, obviously, that doesn't disappear.
That's right. We all need to eat.
Yeah.
Unless you're locked down in China. Look, and Bega is another company that positioned very well, we think. Again, its demand usually is fairly stable for food, and it's really on the supply side you see shocks. But Bega, another business we've owned for some time, raised money 18 months ago to buy Lion Dairy and Drinks at $4.60. Today trades at $4.80. They've had some clear headwinds in their business, particularly through December and January, where we had COVID lockdowns across the country. They've had floods on the northern area that couldn't freight stuff to WA. They've had a huge number of disruptions to this business this year, which has cost them upwards of $50 million, and hence why they're earning only $180 million EBITDA this year. If you back out those disruptions to the business, next year they should be earning in the mid 200s, which is on a P of about 20 times. But it's a business that generates a lot of cash. So the branded food businesses generate much higher cash than their reported earnings, which gives them the capacity to pay down the debt quite quickly and also to grow their dividends in time. Really well managed by a guy called Barry Irwin, who's run the business for over 20 years and always really made really astute acquisitions to really position them for more of a commodity branded business. to a commodity business to a more branded food business, and hence today they own, Farmers Union, Dare, Yoplait in the yogurt category. So they're big market shares in categories that are growing.
Peanut butter. You didn't mention peanut butter.
And peanut butter.
Of course, it's in my cupboard.
I had a big battle with Kraft about using their own peanut butter,
Yeah,
but they've got the livery, and they also own Vegemite.
Vegemite, yep.
What an iconic brand! What an iconic brand!
And I've always said, viewers would know, Bega cheese is my favorite cheese when you just want some tasty cheese. That's anyhow, right. So that's Bega, still a good price right now.
Yep.
Because I can think that's as well, something that investors are really cognizant of. There's value out there now. How long will it remain if we continue to see these dynamics playing out in the market? Now, I know that TPG is on your list as well. What tailwinds? It feels like TPG has sort of multiple tailwinds right now. Growing market share in mobile, international travelers returning. There was a tower deal that was done.
Yeah, look, it's been news flow rich. It's a stock obviously that was heavily impacted by lockdowns again, a bit like Bega. So the earnings are depressed currently. But I mean, at telcos, it's actually going to be it's one of the 3 leading integrated telecommunications companies in the country. But they've just signed a landmark deal with Telstra, which will increase their mobile coverage from about 96% to 98.8%, if approved by the ACCC. That will give them more coverage in this country than Optus. So their market share is well below Optus, and it really clearly positions them as the clear number 2 in mobile telecommunications. As you've alluded to, the absence of overseas tourists reduced and reduced number of people going overseas, reduced their roaming revenue. This business and most telecommunications businesses are fixed costs, and so as incremental revenue grows, and they put out a release just recently saying that the first quarter they'd seen a 70,000 subscriber growth. So they're back to growth in subscribers, and as those subscribers come back, we'll see revenue growth, and that should translate into higher earnings. The other opportunity they have is in the fixed wireless opportunity. So if they can use their mobile network to bypass the fixed line NBN network, again, it's another opportunity to add, maybe a couple of $100 million potentially to their earnings through time. And really the value that we saw in the business, and the reason that, the stock's rallied a little bit recently, is that they had strategic assets. And as we all know, the infrastructure funds of the world are looking for high quality infrastructure. Hence they were able to sell their towers business for close to $1 billion to a pension fund in Canada, and that liberated a significant amount of money, let them reduce their debt, and they've only really foregone $30 million of earnings because they've sold on over 30 times EBITDA. So actually it was accretive for earnings as the interest savings greater than the foregone earnings, reduces the balance sheet leverage and creates a lot of value. And it just highlights that, trading around 7 times EBITDA, that there are a lot of opportunities in the portfolio to liberate value.
First question, is there room for more consolidation in that space? Like, could TPG be a takeover target?
Look, you'd never say no, but at $11 billion, it's not a small company. Yeah. But it could be an opportunity, it could be a target for an infrastructure fund, potentially, given its infrastructure-like. And importantly, they have a significant fibre asset as well, which, would be, I think worthy of trading a much higher value. And we saw that really with the takeover bid that was made for Vocus. I mean, Vocus and TPG were direct competitors in that fibre market, and that business went for 12 times EBITDA, which is a significant premium to the 7 times that TPG currently trades at.
Do you feel that we could be in for more M&A in the small end of the market in particular? I mean, despite the fact that the Fed's withdrawing a massive amount of liquidity, there's a massive amount of money that's still looking for a home.
Yeah, and I think what we're seeing over the last 5 years is, and it's accelerated in the last 12 months with the bid for Ramsay and its approach for Brambles, is that the industry funds have bigger and bigger licks of money, and they're willing to buy these businesses and operate them in the private sphere, taking them off market. So I think there's no company that's not off the radar. Mm-hmm. And I think it'll be a trend that will continue. Just this week we've seen a bid for Infomedia, which is a stock we own. It's been listed for many years, but it's been through a big replatforming. So they've reinvigorated their technology platform. They've got the new next-gen platform. That's making them more relevant to their customers. They've made a couple of acquisitions, one called Simple Parts in the US, which is performing well. And the company still had $60 million of cash from a capital raise they did in COVID when they raised money at $1.59. Stock got down to $1.20. So now we've seen private equity bid for the business at $1.70 and wrap up a large shareholder in Viburnum at 15%. But if you believe the papers, there's an industry player and another private equity player. So there's a potential for a higher bid, and it's sort of 10 times or 9 times EBITDA. It doesn't look expensive. So it would make sense for someone to potentially bid more, particularly if they had synergies. And so it could go for a higher price.
Final question. Oops, I've just been told to wrap, but I just want to squeeze this in because you always mention, price to earnings, and that's obviously fundamentally part of your analysis. Right now, is there a rule of thumb as to what you're willing to pay, or is it very, very company specific?
Look, it really has to depend on the company.
Yeah.
I mean, obviously, if you're infrastructure or infrastructure-like, DCF valuation is more appropriate. We generally prefer PEs. But I think the disruption that was caused by COVID means you have to look through the disruptions caused by lockdowns and supply chain bottlenecks, and particularly disruptions in China right at the moment, to understand what the maintainable level of earnings is. And that's what we spend a lot of time trying to understand, the sustainable level of earnings. And then understanding how recurring and predictable that is, and then putting a reasonable PE on that, and understand the valuation based on that basis.